One of the biggest mistakes in trading is trying to find a universal strategy that works for everyone and in all situations. In this video, I'll show how to choose the right strategy for the market, your trading style and the specific situation, not based on attractive promises. We'll break down real trading pairs, entries and moments where a strategy simply has no chance to work. I want to remind you that I have my own Telegram channel where I share strategies, my personal techniques, provide access to copying my signals and post a lot of useful information. Subscribe, the link is pinned. So let's begin. There is no universal strategy that works in all market conditions. There is only a strategy that fits the current market. The same market can be trending, ranging, or overheated. If you use the wrong tool, you lose money, even if the strategy itself is solid. Today we'll break down the main types of strategies: a trend strategy when the market moves in one direction, a counter-trend strategy when the market is overheated and we look for a reversal and the right entry moment. For each one, I'll show which indicators I use, what the logic is, and of course, real entry examples. Now look, we have a pair open. The first thing we must do is determine the trend. We open the hourly time frame. You can see a sharp drop down here. Before that, there was an uptrend, and now we see a downside breakout. It looks like the situation might stabilize. There are large candles, but it's too early to say. Overall, this is more of a ranging situation, and I don't recommend entering right now. After such drops on the hourly time frame like this one, the market is very unstable. It can reverse in easy direction and becomes unpredictable. So we don't trade this pair, we choose another pair. Remember that we select pairs based on the payout indicator. For example, this one has a low payout, 76. We need above 80. Let's enter here. Now we clearly see a downtrend. We mark levels on the hourly time frame necessarily. Here we see signs of overheating because price reached the previous low and the reversal is starting. Let's check the 1 minute time frame. We mark the low here as well. Price reached the previous low and started to reverse, so the market moved downward and shows signs of overheating. Here we can apply a counter-trend approach. Accordingly, we choose the RSI indicator. We also add Bollinger Bands. We see the candle touching the upper band. A reversal is possible, but RSI is currently stable around the 50 level, which means we can't rely on a single indicator. We can wait for a small upward move and then open a sell. I wait a bit for the candle to turn, tighten up, move closer to the band, and then I can open a sell trade. We enter. The second candle starts forming. There's slight consolidation. It's still above 50 and moving toward overheating. A safer entry would be closer to 70, but I'm limited by the video format. I understand the direction based on both the chart and indicators, so I open a sell. I expect price to move at least to this area and will close in profit within 1 minute. The logic is this: if price continues against me, I don't average blindly. I either accept accept the loss or wait for confirmation for a second. Pay attention, in a trend I trade in the direction of the market. In counter trend trades, I only trade after confirmation. The indicators and the overall chart confirm possible overheating, so I entered a sell against the trend. Now we see a candle moving down, some pulsation, and yeah, we close in profit. As you can see, we earned 360. Excellent. Now I'll take another pair as an example to show trend trading. I choose euro dollar and I will turn off these indicators because if the market is trending and not overheated, we trade differently. There's a clear downtrend here and now we see stabilization. I don't see overheating in this zone, so I'll choose a different indicator. Let me think. Let it be MACD. We look at line crossovers. A crossover is almost forming. We can trade in the direction of the trend. The trend is leveling out, so we can open a buy. But again, I'll wait. I'll watch the 1 minute time frame, wait for a small pullback, and then enter a buy. Price should move roughly toward this level. The indicator confirms this. The lines are very close. When they cross, a reversal becomes possible. Right now there's a strong bearish candle. It may reach the level and then reverse. It might slightly break the previous low, but then reverse. We can't rely only on indicators or only on the chart. Together they work much better. A strong downward move just happened, and I think price will break towards these levels. Now a bullish candle is forming. We wait. Even if we close one trade at a loss, remember, using the martingale system we can recover our losses carefully. Using 1.5, 2 times, no more. The breakout was strong, so we may close this order at a loss and then recess. Yeah, we close at a loss. I now wait for further downward movement and then open a larger buy order. I open the trade and wait for the reversal. Using martingale, I say at 600 to recover the loss. Now price is rising steadily. There was a strong breakout down and now it's the right moment to exit. We found the pullback and entered correctly. Price is now interacting with the moving average, pulsing back and forth. You can see the price dipped below the band as well. I use M57 as a standard, but this can be adjusted. In general, counter trend trading is dangerous. Without filters, it can destroy a deposit because you start acting randomly. That's why indicators are mandatory in counter trend strategy. In trend trading, you can rely more on direction, but you are still not protected for sharp breakouts like the one we had earlier. But as you see, with the second order session even out and we closed in profit. So we had 3 trades, 2 profitable and 1 losing, yet we still have 500 in profit. So the conclusion is, in a trend, I trade with the market direction. In counter trend, I trade only after confirmation. If you mix these approaches, no indicators will save you. You must choose different types of indicators for different market conditions. Trend indicators for trending market and counter trend indicators for overheated markets. This is crucial. And of course, you do technical analysis. You don't rely only on indicators. You must understand the chart, analyze multiply time frames, identify the trend, mark levels, and understand candle behavior. A strategy is not a set of indicators. It's logic plus market conditions plus discipline. If you understand when to trade trends and when not to enter the market at all, you'll definitely be profitable. If you understand this, you're already ahead of most traders. In my Telegram channel, I regularly show live entries like this, explain why I enter or skip trades, and break down mistakes. The link is in the description. Make sure to subscribe. Now I'll withdraw my profit. I choose my wallet. The amount is 512. I click continue. All funds are sent and will arrive within 20 minutes. I want to emphasize again how important it is to understand the market in order to choose the right strategy. There is no single solution for all situations. Trading requires an individual approach. First, you study the market, understand the trend, and only then apply the appropriate strategy. This is very important. I wish you all successful trading. May everything work out for you. I'm always ready to help. See you next time. I'm glad to have you on my channel. Don't forget to subscribe. Bye!